So you're about 60 years of age and you have around $600,000 in investable assets. You've got questions, you've got concerns. You want to make sure that you never outlive your money. You don't want to be a burden on your loved ones. Number two is that you want to get the greatest returns with the least amount of risk, but you can't afford big losses going into retirement. Number three is that you would like to be able to get tax planning. Nobody's helped you with any sort of tax planning. And maybe you also want to get some ways to find out how to maximize your Social Security. So a lot of questions going into retirement, and welcome to another edition of Can I Retire? If we haven't met, I'm Tony Hansman with Guardian Financial, a wealth management firm, and we help people who are in or near retirement. Today I put together a hypothetical case that I want to show you to help you improve your retirement score. So let's jump right into it. So here's our hypothetical case. We have Chandler and Monica, hypothetical. They're both 60 years of age. They're going to retire in 2 years at the age of 62, and they think they're going to turn on their Social Security at the age of 65. We're going to do their life expectancy, both of them at the age of 92 is when we've got them passing away. They think their needs are going to be about $60,000 a year. They have some wants of about 10 grand. We'll explain that coming up on the next few slides. They've got $300,000 in his account and $250,000 in an account for Monica, and a joint account of about $50,000 of non-qualified or after-tax dollars, which we'll explain too. Again, their concerns are, what are they missing? What are they forgetting for retirement? They want to be well prepared. They've got a couple years before this happens. What should they be doing now, and what should they be doing when they go to retire? Income planning, investment planning, tax planning, how to maximize those Social Security, all those things are super important. So now let's go ahead and dive into our financial software and see how we can help them out. Okay, here you can see that Chandler wants to retire at 62 years of age. We're going to give him a life expectancy all the way out to age 92. And then his wife, Monica, wants to retire at 62 as well. And we're going to let her live to the age of 92 as well. They'll pass away at the same time. I'm going to come down here and hit my next button. And we're going to flip over to the next screen, and we're going to take a look at their goals. We mentioned that their needs were about $60,000 a year. That's going to be from age 62 all the way till 92 for when they pass away. And these are going to be considered your basic gas, electric, if they have a mortgage payment. Maybe we'll toss in a little bit of entertainment in there if they would like to hit the movies or some of those types of things. But they also have some travel needs. Like most people, when they retire, they want to do some traveling. So they've calculated from the ages of 62 to 82 for 20 years, 20 times, they want an additional $10,000 a year. And that may mean one big trip a year, or it may be multiple trips throughout the year. But that's the total that they want to spend approximately for those 20 years. After 20 years, once they hit age 82, then that's going to drop back down to the $60,000. The software is already going to calculate inflation in here, so you're going to see these numbers getting much bigger. Wishes, they really didn't have any. If someone did, it may be something like, hey, we want to buy a Lamborghini at a certain age, or maybe they want to take everybody to a big trip somewhere. If they did, we would throw that under the wishes, but in this hypothetical case, we're going to leave that blank. So now let's jump over to the investments and clarify what they have there. So now we're on the investment tab, and we're seeing that Monica has a 401k of about $250,000. We have Chandler 401k with $300,000 and a non-taxable account of about $50,000. The non-taxable account is going to be, we'll classify it as checking, savings, a money market at the local bank. And then the 401ks are going to be the tax-deferred accounts, money that they have not paid taxes on. I would have liked to see some Roth money here. They're in their 60s now, 60 years of age. If I would have met them years ago, I would have encouraged them to keep this a little bit more balanced and to have contributed to a Roth account. Would have been nice. They might qualify for some Roth conversions here. We'll just have to see if the tax planning, how much that saves them. That's only going to increase their probability of score if we add some tax planning on this deal or not. One big thing I want everybody to remember is that it's very common when we put money into a 401k. I love these things. I'm really happy that the fact that the company will set them up and it's an automatic payment that goes right into your account. Definitely contribute up to the free money, at least get the match. You can't give away or walk away from those free dollars. But the biggest thing, and I'm asking you right now, is when's the last time that you have reviewed your 401k? It's so common that somebody may work in 5, 10, 15, 20 years with the same company, and they set it and forget it. They invested all their money into a certain portfolio, and they don't look at overlap that they may have other the same investments in another area. Or the biggest one is the risk tolerance no longer aligns with their dreams, values, and goals. They're way out of that risk tolerance from when they originally set it up years ago. So I'd really encourage you, if that's you haven't looked at your 401k and rebalanced it based on your current risk tolerance, I'd encourage you to do that right away. So let's go now and take a look at their current scenario and see where they fall on their probability of success score. So now we're on their current scenario, and it looks like they have a probability of success, a retirement score of 68. If I come down and take a look if 68 is a good result or not, we'll see that actually they're below the confidence zone. Anything below a 75 is too much uncertainty for their age. So we want to get them to the green zone, in the confidence zone. Somewhere between 75 and 90 is going to be in that green zone where we want them at least to get at. And if we could get them above the confidence zone, that's kind of a bluish color, that's over 90, that would be ideal. So let's take a look at what this means, a 68. This means out of 1,000 different trials, 1,000 different times that they have ran what we call a Monte Carlo, because what's happening here is a sequence of returns, meaning that we all know we don't get a 7%, a 7%, a 7% every single year. We don't get a 5%, a 5%, or 5%. No, we get maybe 10 one year if we're lucky and we're down 10, then we're up 3, we're down 3, we're up 14, we're down 12. The rates are completely unknown. Nobody knows where they're going to be at, what's going to happen. It's hypothetical. But this is running 1,000 different trials, 1,000 different probabilities of what could happen. And it says that they currently only have a 68% chance, or 686 successes in those trials of 1,000. Meaning those 686, they at least had $1 left in their account. The other ones were failures, meaning they ran out of money. So let's take a look at how we can help them get that retirement score and jump over to what we call our what if scenarios. So here we are on our what if worksheet for Monica and Chandler, and they have a current score of 68, probability of success. So let's help them get that score up. Let's see what we can do. And the first thing I'm going to ask them to do is to change the day when they want to turn on their Social Security. Currently, the computer thinks that they're turning on their Social Security at the age of 65. Let's see what it looks like by deferring it just by 2 years, what that score looks like. And you can see it went from a 68 to a 74. Now, I'm not saying that everybody should defer their Social Security. Everybody's situation is different. I just want you to understand and get all the data, all the facts, so you can make the best decision for your family. But very interesting, by deferring it just 2 years, it improved their score by 6 points. So we're moving in the right direction. So let's continue to move on. So now I'm going to take a look at a different portfolio for Chandler and Monica. So if I do this, I select a different portfolio, the computer's going to calculate, and I take them from a 74 all the way to an 82. Now I've got them in the green zone. Things are looking a heck of a lot better for them. Now this is my favorite part of this video, so don't go away yet. Stay with me because I want to show you how I did this. I want to jump over to a risk reward button and show you why I select this particular portfolio. So let's jump over there right now. So here we are on our risk versus reward screen. And you can see at the very top we have portfolios that are very conservative all the way down to portfolios that are very aggressive. And currently, before we met Chandler and Monica, they were in this portfolio right here. A lot of equities, way down at the bottom, pretty aggressive. They hadn't changed their 401ks, rebalanced it in many, many years, and they were outside of their risk tolerance there a little bit. And you can take a look at, if we come across, during the Great Recession, they have a probability of losing 48% in that scenario. Don't want that to happen, but I want to see what their probability looks like if we take a portfolio that is actually more conservative. This is very key here. Can I take a portfolio that reduces their risk but increases their probability of success? So if you take a look at towards the top here, you can see the scores go from 74 to 78 to 79. Up here in a more conservative portfolio, they have higher probability of success. So I've selected one of the higher probability of success, something much more conservative that they can put their money into and not worry about big losses going into retirement, reducing risk and increasing their probability of success. We're moving in the right direction. So now let's jump back over to a what if scenario and see if we can improve that score one last time. So now we're back on our what if worksheet. And you'll see that Chandler and Monica had a score of 68 before we met them. We asked them to simply move their Social Security from 65 to 67 when we went to turn it on, and that moved their score up to a 74. We made one other change. We actually reduced their portfolio risk, and that increased their probability of success up to 82. And now let's do one last thing. Let's ask Chandler, not Monica, just Chandler, to work one more year, and let's just see what that does. So if I go up here, I preset this and I select go, you can see it takes them from an 82 all the way up to 93 by Chandler working just one more year. Now they're in that above confidence zone. We're doing really, really well, and we went all the way from a 68 score all the way up to a 93 score. We could keep going on and keep going on improving, but we just wanted to show you 4 or 5 different examples of how to improve that score. So I hope this was extremely helpful. I hope this video was helpful. The goal is to give you ideas and tips of how to improve your retirement score. And if you'd like to know your retirement score, if you don't have one, simply reach out to us. Our information is in the description box below. Please remember to like and subscribe, and as always, make sure to work with a licensed professional who understands your specific goals and dreams.